I have a quick question about valuations.
Sure.
So uh, after I've looked at a business's financial statement and done a recast, if the value extremely heavy in comparison to
Wait, Kevin, you went silent for a minute there, so
oh, sorry.
back
Okay.
up just a minute because I need to
Okay.
make sure I understand the full question. So after you've gone through and you've done your recast, then what?
Do I take into consideration the value of things like equipment or inventory, or do I just consider that what was necessary to create that business's profit? Does that make sense?
Yes. So there are three different types of valuation methods that are used. You've got, or approaches rather. So you have an income approach, an asset approach, and a market approach. If you are, typically an asset approach is used when you have a lot of tangible assets, like a lot of machinery and equipment, but not a lot of cash flow. And so if the cash flow is really insufficient, you might get a higher value off of looking at your equipment and doing an equipment appraisal. And so you may need to do it that way. Typically, if you're using an income method or if you're using a multiple of earnings method, then your equipment is considered what's necessary to manufacture the widget. Okay, if you have, whatever types of machinery and equipment you have. So that is all considered part of the business. It's not considered separately. It's not added to whatever your multiple of earnings is. However, inventory can be added on top. The thing you have to understand with inventory is that if they have excessive inventory, then probably buyer is not going to want to buy all of the inventory, and you're going to need to consign some of it. So, or seller's going to need to consign some of it. So, for example, if you have a business that's generating $500,000 annually in revenue, and they have $300,000. Well, no, let's say they have $800,000 worth of inventory. Then the buyers are not going to want to buy that $800,000 of inventory because it's going to take them, if the gross revenue is only 500,000, it's going to take them a year and a half or 2 years just to sell off that inventory or have that inventory turn once. So they're not going to want to buy all of it. And they're not going to be able to finance it. I mean, a lender is not going to provide a loan that would allow them to purchase all that inventory, because if the company's doing $500,000 in revenue and has a 20% net profit, then it's making $100,000. Well, you can't pay 800,000. On a multiple of earnings, you'd be looking at a business with SDE of $100,000. You're probably looking at a $200,000 purchase price. So if you have 800,000 in inventory that you're trying to add on top of that, now you're up to $1 million. Well, lenders are not going to loan $1 million or 800,000 or anywhere close to that if the business is only generating 100 SDE, because it can't afford to cover the debt service, right? So your multiple of earnings, your equipment is typically included in it, and your inventory may be added on top of it, as can accounts receivable, if there is any. Buyers are going to want some working capital, probably, depending on the size and price of the business. And then the market approach is the last approach to valuation, and that's where you're looking at biz comps and deal stats and other databases, looking for comparable businesses to see what kind of multiples that they were sold for. Just understand that, I mean, in my experience, it's really hard to find actual comps a lot of times. You're not comparing apples to apples, and I've just never found the databases to be much help. So, and especially if you have a business that's kind of in a niche, and there's not a lot of them out there, because you have to understand, unlike real estate, there's no requirement for private business transactions to be recorded anywhere. So what you find in BizComps and Deal Stats and all of those databases is a fraction of all the transactions that actually occurred. And trying to find transactions in your state that were within the last 3 years or some reasonable time period in order to get comparable data is, it can be challenging. So I haven't found that to be useful. I mean, most of the time I'm looking at multiple of earnings. There's also a hybrid method that you can use that is used, I use that from time to time. And that is where maybe it's equipment heavy, but there's also reasonable cash flow. And so you're taking the tangible, you're kind of doing a hybrid between the asset and the income approach. You're taking the value, the used value of the tangible assets and adding the cash flow to it. No multiple of, adding the earnings to it. So you're not applying a multiple to the earnings though, because you can't do both. Either if you're using a hybrid, it's just going to be assets plus earnings. Does that make sense, Kevin?
I think so. So if you do a hybrid, you don't apply a multiple to the earnings.
Correct. So let's go back to that other example, $500,000 in gross revenue and 20% net profit margin or 20% SDE. So you got 100 grand in SDE, but let's say they have 300 grand in equipment. So you're looking at, on an asset value, it would be 300, value would be 300. On a multiple of earnings, you're probably looking at 200, okay? Because if it's making 100 grand, you're probably in that 2 range. And maybe a little bit more. You might be able to get 250. And then if you try a hybrid method, the hybrid method is actually up at 400. So that's not going to work. That's going to put you out of the ballpark. So all of these things that, valuation is an art and a science.
No
You
kidding.
look at the business reference guide, you get the rules of thumb, you look at, and you apply all of them. If business reference guide says one of the rules of thumb is 40% of gross revenue or gross sales, then you look at what's 40% of my gross sales. And you say, okay, well, that would be 200,000. Well, does that goes hand in hand with what I just came up with on my multiple of earnings, right? So you look at all of these and you throw out the outliers and you come up with a reasonable pricing model. There's no one way to do it is the bottom line. There's no perfect and there's no one way to do it. And at the end of the day, the market is going to dictate what they're willing to pay anyways. So your job as a business broker is really just to do as much as you can to try and get to a reasonable ballpark and get to that right market value so that you can attract buyers. Because if you price it way too high, which is what sellers usually want, like, no, I want $1.2 million. Okay. Well, but if I market your business for $1.2 million, nobody's going to inquire on it because the buyers are going to look at it and say, well, that's ridiculous. Move on. They're not even going to submit anything. Right. So you want to be within the ballpark so you can attract interest. And then ultimately the market's going to dictate. And they're going to dictate based on other factors too, that you're not even taking into account when you're doing your initial valuation. Like, for example, buyer learns that 40% of the workforce has to be replaced because they don't have I-9s. So they're not allowed to work in the United States. I don't know. I mean, most of the buyers in California, a lot of the buyers are not going to do that. They're not going to take on that risk. In other states, they may. And even here in California, a buyer may take on that risk, but they're not going to pay for it. And they're not going to pay the seller for it because it's a risk. So they're going to discount the value of the business accordingly. The higher the risk, the lower the value of the business to the buyer.
Can I throw something extra in there if you don't mind?
Absolutely.
Can you hear me? Because I
Yeah.
switched up my Yeti here. So when we're applying multiples, I think one of the things that people forget is that there's a range of multiples. And, at the Exit Planning Institute, we like to teach that, you have this whole range. And unless the business is best in class, you really can't apply that highest multiple if you're going to use multiples. I'll reiterate, I use discounted cash flows because I'm looking at revenue. But for those of you that don't do that, just because the rule of thumb says 4x, if the business doesn't have good books, or if it doesn't have, if it's totally owner centric, or if it's a bunch of other things, you can't apply that 4 multiple. You've got to adjust it based on how the business actually, how attractive it is to a buyer. And then remember that the buyer comes with an attorney and they're going to want to knock you down. So you have to know why you're applying those multiples and be really solid with that.
Yeah, absolutely. The other thing that is that, going back to a range of multiples, your multiples are going to vary depending on the level of SDE that you come up with. So if your SDE is 50,000, you're looking at probably a 1 or 1.5, even though the business reference guide might say that you're at 2.5 to 3. But because the SDE is so low, the buyers, I mean, it's going to be again, the lower the cash flow, the higher the risk, because when you have a good amount of cash flow, let's say you're dealing with a business and they've got $1 million in discretionary earnings. Well, you got room to play. So the seller, or the buyer rather, can take home a reasonable salary. Let's say the buyer wants 300 grand a year. Okay, he can take his 300 and he's still left with 700 that he can hire experts to do what needs to be done in the business, or he can replace employees, or he can he can initiate different types of incentive plans or bonus plans, or there are a lot of things you can do when you have cash flow. But if you have a business that's only got 50,000 in cash flow to begin with, well, now buyer probably needs that to live on, and depending on what state you're in, that's probably not even sufficient to live on. so you've got some issues now. So it's a much higher risk. And because the higher the risk, the lower the value, your multiples are going to come down when your cash flow is smaller. So 100 grand and up, at a level of 100 grand, you're probably looking at about a 2 multiple. But if you are under 100 grand, you need to deduct half a point. You're probably looking at 1 to 1.5. If you're up at 95,000, well, that's close enough. You can probably stretch, and you might be able to get close to 2. And there are I'm talking generalities again. Every deal is different. On occasion, you're going to have somebody who comes in who is willing to pay a little bit more for one reason or another. So there's no hard and fast rule that says, okay, well, you're getting, you have 78,000 in SDE, therefore your business is worth 150 grand, period. It just doesn't work that way. So it's an art, it's a science. You get a feel for it when you work through enough businesses and do enough valuations over the years. You just get a feel for it, and you just know, okay, well, this type of business, this is going to sell for, maybe 75,000, and this business has good cash flow. It's got SDE up around 250 grand. So yeah, I can probably get 750 for this, 700 to 750 for this business. You just know that. And you start pricing things accordingly. Questions? And then there's always the seller arguing and saying, no, even though I know that you're telling me that it'll probably sell for 7 to 750, I want you to price it at 850 anyways, just so I have room to negotiate. right? I mean, you sometimes you just do it because, I try and make a deal with them, say, okay, well, I'll price it 850, but if we're not getting any kind of response in the first month or two, then we're going to automatically decrease. So, but sometimes they say yes to that. Sometimes they say no. They say, no, I don't want any automatics. No automatic reductions. You just let me know what you think and we'll make a decision at that point. Okay.
There's a joke in the valuation community. You could have 10 valuators and you'll come up with 11 valuations.
That's very true.
It's not like residential real estate where you have those market comps. You started the whole conversation. I'm sorry I missed the first few minutes with the using the databases for direct sale, for direct market data.
For market approach,
Market approach,
Yeah.
And so unless you're in a public sector where they have to report everything, they don't have to report their inventory. They don't have to report anything. But when you're looking at that data, you don't know what the inventory was. You don't know what the benefits to the key people were. You don't know if all the employees were their cousins. You have no idea what's in that data. And so I never use it.
Yeah. I mean,
it's like a rough rule of thumb, really rough.
I'll use it, to be honest with you, I'll use it if somebody is paying me for a valuation and then I need to go through and use multiple approaches and all of that and to put it into a written report, then I'll do it.
Yeah.
But if it's something where I'm trying to qualify whether or not I want to represent a business, I'm not going to waste my time on that, because to me that is a waste of time. I'm more interested in, let me look at your books and records, let me look at your tax returns, your P&Ls. Let me get a little bit of data about the business. This is the range. Is this a range that makes sense to you? If it is, great. Let's move things forward. If not, what are you looking for? What's your target? And, here's some things you can do to maybe start working towards that target. It's probably going to take you 3 to 5 years. If you want to work on it together, we can. If you want me to refer you to somebody, I can. What do you want to do?
I just picked up a volleyball league that they want to exit eventually, but we don't know what kind of exit it's going to be. And it went from, oh, we'll just franchise to maybe we do want to exit to, well, we've got a 2-year plan that we've just put in place and we're finalizing on Friday. And it is going to be at least 2 years before that business is ready to go to market. A lot of coaching.
Yeah. No, I remember talking to some guys at an accounting practice, and they were telling me that, they would never sell all of the partners basically wanted to retire, and they were having to retire in staggered periods of time and try and groom somebody to replace them as partners. And I remember talking to one of the partners, he says, oh yeah, we'll never sell to a bigger accounting firm because we have, the culture and this, that, and the other thing, and the partners are never going to want to work and blah, blah, blah. And then 2 years later, I get this notification that, oh yeah, we've been acquired by so-and-so. I just started laughing.
The roll up, yeah.
It's like never say never, right?